All right. I'm here with Chris Spratling, and he is the founder and managing director at Chalk Hill Blue. How's it going, Chris?
Yeah, really good, Steve. Thanks for having me on. It's great to
Yeah.
be here.
Yeah, I'm excited to get into this. Before we get started, let's talk about your background. What got you into business?
I guess I always had a healthy interest in business. I started off in the media world, working for a number of consumer magazine publishers. Did a stint in national newspapers, and I guess over that time I got quite good at sort of scaling businesses, repairing some ones that weren't quite so successful, and reorganising them. And then went on and did some work with private equity before having, I suppose, my own entrepreneurial seizure and starting out in businesses of my own, where I guess I'd eventually woken up to the fact that I'm a square peg in a round hole and probably asked too many awkward questions of employers. So, yeah, started out on the journey with an online business and then developed a consulting business, which is where Chalk Hill Blue stems from today.
Very cool. Very cool. So let's start unpacking this. I think, you have a lot of experience working with a lot of different entrepreneurs, and I'd like to kind of start with timing. Like when you talk to a lot of different entrepreneurs and they're running a business, everybody's in different industries, different chapters of their lives. What have you learned over the years around when the right time to exit is?
Look, I think one of the observations I would make very early on is most owners think that selling a business is an event, and actually, that the biggest learning I think that I'd like to give your audience today is that actually it's not an event, it's actually a journey that takes an amount of time, often a number of years, to ready a business and also ready the sellers for an optimized event. So it's the journey. Yes, it culminates in an event, but fundamentally, it's a journey. Um, I think that we talk about it in my book that there's an illusion of readiness, and owners often fall into the trap, I think, of believing that their hard work translates directly into value. And as many of your listeners will understand only too well, is buyers don't really see it that way. What buyers are looking for is transferable value and value that is, to all extents and purposes, risk free. And so, preparing the business for that situation requires a real focus on the key drivers of value rather than just building a profitable business. Because
Mm,
often we find profitable businesses don't reach optimum value when sellers want to exit.
got it. And that's a good segue into what does actually drive value. Like I know a lot of times on the pod we talk about transferability, making things that aren't really connected to, the founder themselves so that it can be transferred. But what are some of the key drivers that you see when it comes to value?
Yeah, I think it's about bridging that gap between perceived value and market value. So, as acquirers of businesses, I guess what most people are looking for are 8 to 10 key drivers of value. So they're looking certainly for a strong history of growth, but they're equally looking for a potential to scale up because, of course, as a seller, that's the end of my journey when we transact. But of course, for the acquirer, it's just the beginning of their next journey. And so they're going to want to see that this business has a real potential to scale. Um, they're going to want to minimize that risk, as I just touched on. So they're going to be looking for hopefully things like recurring or contracted revenues. They're going to want to know that alongside that there's a strong market positioning, ideally some points of differentiation that give that business an opportunity to achieve, you know, industry levels of net profit, if not above industry normal levels. Um, as you touch on, they're going to want to make sure that there are low levels of reliance against both key staff, the owner, and indeed key customers and suppliers. And then alongside that, I think you're going to see drivers that are particularly important in terms of healthy working capital, high levels of customer loyalty, and wherever possible, strong intellectual property. So I
Hmm.
think if you can blend, a number of those together, then you're much more likely to achieve optimum value at an exit than if you just drive a business just for the bottom line profit.
Hmm. And kind of an extension on the timing piece. I think that there's a lot of different opinions that I get on a regular basis about if it's worth going on for a couple more years or if it's
Hmm.
worth sort of selling today. You let's say you thinking about it, there's even an opportunity that presents itself today, but what do you see as kind of that the difference in value there, where I could continue on forward for a couple of years scaling this up, or I could take the deal today? What's your take on the two?
Look, I think it's a really interesting question. So thank you. When I have conversations like this, and I'm sure you've had many as well. Most of the emphasis focuses on the business's readiness. Is it ready to be sold?
Hmm.
But actually, there's a much more fundamental issue around readiness of the seller, and often you'll find that sellers actually um, are unsure about whether they're ready to sell. So part of preparing a business for sale is also working hard on yourself as the business owner to understand how ready you are to sell. So, what are your motivations? How much do you need? How much do you want? What do you want from the transaction? In terms of, is it just the money? Or alternatively, have you got other criteria that are important to you in terms of the type of buyer, how they'll perhaps continue your legacy, how they'll look after your team that perhaps got you to the point of exit, etc., etc. So that readiness piece is something that applies to both the seller and indeed the business. Now, alongside that, I think it's also about understanding, would anybody really want to buy this business, and would it be able to run without me, the owner or the founder of that business? So all of these things have to come together. And so, in terms of holding on, I think it depends on what we want as individuals out of selling our business and whether the timing is right in that sense. Um, but let's not forget that selling a business is a journey, and it's particularly a journey when we get into taking that business to market and going through the process of attracting, hopefully a range of interested parties that meet with your criteria as a seller, and that will take time. So again, it's understanding that timeline to actually take a business to market to ultimately completing on a deal and knowing what you're going to be doing whilst that process is going on, because the business doesn't have to be at its optimum. In fact, as I said earlier, you want there still to be further growth potential. So, sometimes waiting too long can be the worst thing, but equally going too early can be pretty poor as well as a decision. So, you know, it comes back to, I think, what do you need from the business and what do you want from it.
Hmm. And before we get to kind of deal structures, which is always a fun part, like the offers that you will get with the earnouts and all that good stuff. I'd love to kind of unpack a little bit about valuation, because we're talking about driving value, we're talking about the things that people can do, but what are some kind of tactics that you've seen really work when it comes to negotiating the value of a business? If a multiple buyers, you mentioned that immediately I had a light bulb. That's what I always hear is the number one way that you can approach a negotiation is when you have multiple bids, right? Like multiple people at the table. That's how you can really increase the valuation. But what have you seen work over the years with kind of increasing that value?
I think if we just go back a step to some of the stuff I just touched on, albeit very loosely, um, I think it's about what sort of business am I building with a view to a sale, and a sale to whom? Because different types of buyers will value the same business in different types of ways.
Mm-hmm.
So, a high net worth individual is probably going to be looking for very different things to a private equity type buyer or indeed a trade buyer. So I think, when we take our businesses forward to market, yes, ideally we would market to a range of different types of buyer and have built it with that different range of buyers in mind. So I think that's the fundamental point that people need to think about very early on in readying their business for sale, and indeed readying themselves for sale, as I said a minute ago, so as to know what type of buyers they're prepared to sell to. Then I think once you've got those criteria clear, the smart sellers are able to look well beyond the numbers and balance the, if you like, the headline figures in terms of price with structure and fit against their individual criteria. And I think that's critical, you know, long before you start looking at, the attractiveness of different types of earnouts, non-competes, transition rearrangements, and so on and so forth. So I think it's about deal alignment with those personal exit goals.
Mm, deal alignment. I like it. Good way to move into deal structures. So I I'm always interested in how people think through a deal, especially when it comes to the team, when it comes to cash up front, earnouts, stock, all of that. So I'm curious to get some advice, that you give out to people around, non-competes, transition terms, stuff like that you've seen. What do you always suggest to people that are going through the process?
Again, I think it's a very personal decision. Certain people are going to be very happy to stay on. We helped a client sell 3 4 years ago now, and they originally agreed to stay on for 2 years as part of a contingent earnout. They've actually ended up staying on 4 years, and they've almost doubled what they thought their initial consideration was going to be. Because they've really helped the acquirers scale the business to a level that, frankly, is way beyond that. So I think as long as it's fun, then I think there's an important point there that if we do things that are fun, we generally enjoy it and we stay on, and as long as it meets our personal goals, are significant. Others aren't saying, but you promised me we were quitting and we were going to the beach, and that's not a problem. Well, then stay on and so on and so forth. But um, look, I think it's all about that fit point in terms of whether are these people I think I can work with, am I prepared to hang around, or actually would I just value a lower offer and get out of here quick? And I think everybody's different in terms of their view on those sorts of things.
Hmm.
Um, I think it's important for acquirers to really understand what's important to sellers. If I give you a personal example, I also own, a reasonably successful accountancy practice. We've just had an offer accepted to buy another practice as part of our scale-up plans for that. Um, I've spent a huge amount of time trying to understand what's important to the seller, and actually, yes, the headline number's important, but the tax efficiency of the way the deal is structured is the most important thing to him. And so we've come up with a deal structure that is highly tax efficient, and fortunately, it works for us too.
Nice, very nice. Yeah, researching what's important to seller as a top priority is good. I like that because it really,
But interestingly, most acquirers don't do that.
yeah.
So as a seller, whether it's you doing it personally or whether it's through your corporate finance or your broker team, I think you have an obligation to make sure that potential acquirers are clear as to what's going to tick boxes for you.
Hmm. Hmm. So yeah, that's an interesting one. I like that, kind of researching because it is at the end of the day, it's humans selling to other humans, and you need to be kind of on the same page, making sure that the incentives are right. And oftentimes with team that comes over, things kind of fall apart and things kind of get a little bit messy for a lot of deals that are kind of not discussed beforehand with teams and stuff. It can get dicey. So I'm always curious to get people's take. And when it comes to like the role that the founder has, I've done this myself. Um, when
Yeah.
got acquired and went to a bigger company by the acquiring company, how should founders think about their roles in the acquiring company? You mentioned a great example of somebody who stayed there for a long a long time, but what are some sort of ways that people can think about it when they're getting acquired and joining a larger organization most of the time? I think it's a bit of a mental struggle that a lot of founders face.
Yeah, look, so a couple of thoughts for you. Um, for me, a successful exit doesn't end on completion day. It continues throughout that transition of ownership. It continues through that process for not just the seller, but for the team, for the customers, and indeed, of course, for the acquirer as well. I think the best founders who ultimately exit treat handover as part of the sale process itself.
Hmm.
Um, Hopefully, by then, they've put some of those key drivers in place, they've empowered key managers early on in that build process. Um, and the business isn't overly reliant on them, but I think the job of the seller is to ensure that smooth transition. Now, again, if you've done the seller readiness piece there, you've hopefully narrowed it down as to what you think would be a good home for your baby that you've built over many years.
Hmm.
And hopefully in assessing the different offers that come in, let's take a positive view that you've had multiple offers, you found the acquirer with the best fit and one that you feel you can work with collaboratively to ensure a quick but smooth transition of power. And so I think I'm not giving you very specific examples here because I think it's quite top level, but I think it comes down to fit. And do you really understand what the acquirer wants to do with this business? So what are the acquirer's future plans for it? Does it fit with what you hoped an acquirer would do?
Hmm. And when it comes down to it, I think evaluating deals, like we talked about how talking to the seller is crucial on the buy side and
Hmm.
figuring out what's important to that seller, making it more of like a fit and making it a little bit more of a less bumpy acquisition. When it
Yeah.
comes to what's changed with buyers, I think a
Hmm.
lot has changed over the last 10 years. What have you seen in terms of changes from, even 10 years ago, 5 years ago? How are those sort of details different when people come to the table with it?
Um, I think definitely if you went back pre-COVID,
Hmm.
you would have seen most buyers driven by growth.
Hmm.
That was their number one motivation. Today, I think most buyers buy predictability. They want to know that they're buying something of quality, something that is going to be resilient to market pressures, even pandemics, if possible, etc. So they're looking for solid systems, scalable operations, low owner dependency. Essentially, they're looking to minimise their risk. Today, clearly they're looking for potential to scale, as we said earlier on with one of those drivers. But um, it's definitely they're looking for predictability, rather than hockey stick growth. I
Hmm.
would say. Um, I think you've seen over the last 5 years in particular that due diligence has got a lot more forensic, particularly the financial due diligence, um, and increasingly, um, things like customer loyalty have come to the fore. Previously you would have seen private equity groups using metrics like net promoter score to evaluate whether it was a decent acquisition or not. I think you're seeing that much more widely used across the board. I think that the due diligence is increasingly focusing on things like culture, um, uh, and sustainability is a much bigger issue these days for acquirers than it ever used to be. I know different size of the pond, different buyers will have slightly different emphasis on some of those environmental and sustainability
Hmm.
elements, but generally we're seeing more of it time and time again.
Yeah, and it's kind of a good segue into strategic buyers versus like more of a financial focused buyer, because
Mhm.
I've met a lot of people that have sold to both the sort of s- straight P&L buyer, and then the people that are in the similar space, like you said, where accounting firm buying another accounting firm is a great example of like a
Yeah.
strategic growth initiative. So what have you sort of seen as the big differences between these two over the years when you have people both sides where sellers are looking at both of these different potentials?
Yeah, I mean, look, I don't think necessarily the different buyer types have changed dramatically, in terms of what they primarily look for. I mean, I think if you look at trade buyers, they're invariably looking first and foremost for synergy.
Hmm.
Um, Private equity guys are generally looking for growth potential, increasingly with that predictability that I just talked about. Um, the high net worth individual, sometimes the family office that's acquiring, again, are looking for a bit of both, but often a predictable income stream, is part of what they're looking for. So I don't think those key criteria have changed a huge amount over time, but it is important to understand what the different types of buyers are going to look for, um, and whether you know there's real alignment, as we said a minute ago, with what you're offering as a story as to how that business will grow. Many acquirers will actually take on board your growth story, um, but they'll actually dismiss it. They'll say, look, that's all very well and good, and we can see how those valuations are reached, but actually we've got a different plan. But again, it's how robust that base business is, I think, that give them the confidence to buy and build their own predictable revenue and fit.
Hmm. Yeah, I think that that's always the struggle on the sell side is figuring out who who to go with. Like there's definitely different things to weigh up, and it kind of goes full circle to what you had originally said is what you want with your life, what kind of outcome that you really are
Sure.
seeking as a person and as a founder. I think it's kind of good that it goes full circle. So that takes us to the finale. Knowing what you know now, what would you tell Chris 10 years ago?
Um, Prepare like your life depended on it. I think, preparing a business so as to be saleable from the get go, as opposed to trying to re-engineer it halfway through the journey is a lot easier. It's b a lot cheaper, um, and if you do that, really you haven't got to worry because a business that's ready to sell is equally a great business to own. But I think when you look at the stats, if 40% of businesses that are actually sold, are actually never formally taken to market because the owner gets an unsolicited approach. You've got to be ready because actually the emotional roller coaster, will kick in. You'll get swept along with the headline number that's been dangled in front of you, and before you know it, you've sold the business without really knowing, what it is you wanted from a transaction, in terms of fit, in terms of value. And when you look at the stats again, and I think these stats are fairly common on both sides of the pond, you know, well over 50% of sellers tell you that within 12 months they regret doing the deal they did. And that's simply a reflection of not being well prepared.
Hmm. Yeah,
So,
I think being prepared is definitely pretty crucial with your number one defense when it comes to this stuff. And I think there's a lot of mental stuff that goes into it where during the due diligence process, a lot of founders that I talk to agree that you get to a place where if you're in 6 months deep into due diligence and it almost gets to a point where your valuation has been devalued so much by the buyer for X, Y, and Z, like a whole laundry list of reasons why it's not not a
Yeah.
not a good position that you're in. You get to this weird place where it's like they're doing you a favor for coming in and buying it at such a discount, and it gets to this like crazy kind of bizarre world where you're like, wait, actually, no, my company is still growing. I'm still doing all of these things, and I everybody that I've talked to over the last couple of years that gets into this like final chapter of the DD phase would agree with what you're saying of like if I would have prepared up front, I would have just said no to this specific person and not gone through 6 months of just deep due diligence and like you said
Mhm.
forensics. It's just it's crazy that often a lot of people just feel like they need to pursue it.
I think, look, if you prepare well, start early enough, you can build yourself defensible positions around all the things the different types of buyers are likely to try and pick holes with.
Hmm. Hmm.
And actually, you know, in my experience, acquirers who come up against a robust seller who's said, no, 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 look, let me show you how we've already ticked that one off and how that's not the issue that you might fear it might be, actually respect that, and often will pay a premium as a result of it. So, let's not forget that the first offer is invariably not the best offer.
Hmm.
Okay, we had a client last year who sold. Um, Now, unbeknownst to the acquirer, they were actually the only show in town. But the difference between what they actually paid and what they initially offered was nearly 40% in the positive.
Oh,
Because actually, the seller was really well prepared and was able to push back and, through their corporate finance team, were able to say, look, I think you may have misunderstood this a little. Not sure you're truly valuing all of these things properly. And we built enough of a headroom, to really get optimum value, way beyond the seller's expectations of what they had set out to achieve, and actually got a really good deal in terms of the deferred consideration. So
nice.
very large part of the total consideration came on day one, with the remainder over a couple of years, but a relatively small percentage over that next couple of years. And it was important for that seller in particular to have the certainty. So even though the business continued to grow, after they exited, they were happy with the certainty of knowing how much they were getting. And I think that's the fit point.
Nice. And yeah, that's crazy. 40% is awesome to hear. Love that. And I've heard of a lot of different tactics over the years. One of my favorite ones was I forgot his name, but when we talked on the podcast offline afterwards, and he said from LOI to the point where you go into conversations, you share just one or two metrics that you know you're going to crush, and you say these are the
Mm-hmm.
metrics that I want to share with you today. By the end of due diligence, I am going to double these numbers in the business. So all of the rebuttals, like all of the holes that they're trying to pick throughout the due
Mm-hmm.
diligence, you just keep reminding them of these these two metrics, and it's like a way to like consistently show that you're moving forward and you're growing. And I thought that was always a fun, like a kind of counter attack to just the
No, look,
whole
it's,
whole.
it's, it's an interesting tactic. The key, of course, is making sure that the two or three metrics that you select to keep referring back to are the right sort of metrics for
Mhm.
that particular type of acquirer.
Yeah.
So you may have to develop, you know, five or six so that irrespective of which preferred bidder you go with, you've got two or three to lean on.
Hmm. Hmm. Well, that kind of takes us to what are you working on now, and where can people learn more?
Yeah, so the work we do at Chalk Hill Blue is all about helping ambitious entrepreneurs both scale and for a number of them it will be ready themselves for exit. In terms of work today, I think we've got four clients that will hopefully secure a successful exit before Christmas. So not long to get those over the line, but they're all at good stages respectively. So yeah, no, look, they're the ideal sorts of clients for us, the people who want to really exit for optimum value. So,
Mhm.
if anybody's interested in learning more about how we help clients do that, for sure reach out.
Awesome. Awesome. Well, wherever you guys are listening on iTunes or Spotify, the links that Chris mentioned will be in the show notes. But thank you so much for coming on and sharing all your wisdom, Chris.
It's my absolute pleasure. Have a great day.